Let's go to John Johnson. So pleased to have him back with me on the show. He has had such a terrific track record when it comes to talking about what's happening with the economy, the Canadian dollar at that. He's Executive VP, Chief Strategist, Davis Rea. John, thanks for finding time with me.
Oh, my pleasure, Michael. It's nice to be talking to you.
Now, I was just saying earlier in the show that, man, the real kickoff to the next section of the financial year comes in September. It just seems that things are so quiet in August. I don't know whether to take things seriously or not when I watch trends develop, whether it's a rise or fall in oil prices or what's going on with the Canadian dollar. It just seems that volume shrinks so much with so many people on vacation, so I say maybe I should put stuff on hold myself.
Yeah, that certainly seems to be the case. I tell you, in downtown Toronto, it's been like a bit of a morgue for a good hunk of the summer. It seems that it's been a great summer, so people have been taking advantage of it. And after the first half of the year was pretty eventful, so I think people took the opportunity to enjoy themselves. And I think we'll get a sense as we come back, as everything kind of moves back towards normal in the next 10 to 14 trading days. We'll get a sense of those trends because. I look at the price action in, say, the S&P 500, and some of those days and days of these minuscule point moves. I don't recall ever seeing that before.
Yeah, that would certainly be one of the highlights or headlines coming out of this summer is that small trading range and lower volumes, of course, but that small trading range, they act as if there's no volatility whatsoever coming at us.
Absolutely, and I look at it and I go, okay, we've had this amazing rally off the lows in February, and we were due for some sort of consolidation or correction phase. Was that a true consolidation in this quiet trading environment, and is that building a base to move higher from these elevated levels? I think the jury's out on that. I'm seeing reasonably decent signs for the global economy, but even then, I think that the quote you talked about earlier about the presidential candidates in the U.S., I think there's a whole lot of political risk there that's not being built in. I do see signs of economic improvement, but I don't think it's anywhere near what the consensus of economists or equity analysts have built into their growth numbers, either for GDP or for earnings. So I think there's some room for disappointment there still. So I think that there's still room for choppiness, and I think we could still see a correction. So I think that we'll end the year higher, but I think that the next 5 to 6 weeks could be unpleasant.
One of the challenges is that assessing whether the stock market's moving because it's the only game in town, in quotes, private equity would be also some forms of real estate. Yeah. But the bottom line is when you've got a bond market that's yielding so little, you have pension funds that need, significantly more. You get a 10-year bond at 1.5% or something, but your pension fund needs to be averaging around 6.5% to 7% a year. Well, they've got to put the money somewhere. And I'm wondering to what extent that's what's going to drive these stocks.
Well, I think that's the key point. When we were at your Outlook conference back in January, things were looking pretty rough. And I think on the Friday of the conference, we'd hit a low, and the Bank of Japan came in and surprised everybody with the move to negative interest rates. And then things got worse in February, and the European Central Bank came in and did a more aggressive than expected round of monetary stimulus. The Fed backed away from its rate hikes to a degree, and the central bankers basically stepped in and put a bit of a put here under the market. And they're making it so that income-oriented investors are finding it very difficult. You really do have to reach. In the bond market, you've got to reach out into high-yield bonds and take on that extra risk to get the income. Going into the equity market, you're going in for the dividend stocks, so that they tend to be a little less risky. So the portfolio is not getting. It is riskier overall for a lot of people, but it's certainly a lot more vulnerable to downside corrections than the portfolio that they would have had 5 years ago.
Let me backtrack. Sorry.
Go ahead. Sorry.
I was going to say, let me backtrack to interest rates for a second. Broad question: would you go near the bond market at these kind of rates?
Not. I would view the government bond market as, the short end of the bond market would be cash, and that's purely for tactical reasons. So if if we've had a big run and you're a little nervous, you think there's a correction and maybe some better prices ahead, some short-dated bonds for a period of time would be great, and T-bills. As for the corporate bond market, certainly during periods of weakness, I'm inclined to put cash to work. But I wouldn't be. I don't think that the returns are going to be there for what people need. So we're being forced to move into the equity market and into the dividend stocks. And one of the things I take some comfort in is that it goes back to some of the themes that got discussed at your conference is, in the longer term, do you want to bet on the government or on the private sector? And I think we're in an environment now where one wants to bet on the private sector, so that can be done through the equity market as long as you're prepared to ride out the inevitable ups and downs. And I don't think we're in I think that basically we've avoided a global recession so far. That takes a lot of the downside vulnerability in the equity market out. So it's not an unreasonable position to be in at this point in time. I don't want to sound too optimistic because I'm still on the pessimistic side of the economic growth forecasts, on inflation, on interest rates, and I think there should be a bigger premium, a risk premium built into equity valuations. But at the same time, I'm not overly concerned.
We just got the GDP numbers out of the second quarter. It wasn't a surprise that we contracted, because of the Fort McMurray fires, the prominence of oil in the overall economy. Yeah. We're going to get a boost in the third quarter. But I looked at some of the underlying numbers. I mean, for me, I don't see any sign that the Canadian economy is doing anything but, we're aspiring to mediocrity and we're not there yet. And so I don't see any reason to see any rise in interest rates on the Canadian side of the border. Really we can pick a time frame, but it doesn't look like it's in the near future.
Oh, I agree with you 100%. We are getting the snapback that showed up in kind of the export numbers, but even then, they still look kind of weak, a little more than would be suggested just by the fires in Fort McMurray. So I think one wants to be really careful here. And my belief is that if we didn't have a housing issue, a frothy housing market, and a huge overhang of household debt, I think the Bank of Canada, the overnight interest rate would be lower than 0.5% now. I think that's constraining them on the downside, and I don't think there's a case for raising interest rates for years to come. The idea of aspiring to mediocrity is right. The OECD and its innovation studies and the IMF have put Canada in the new mediocre in terms of innovation and the ability to expand over time. And I think we're in an environment, and I haven't seen much research on this, it's more of a hunch on my part, is where do economies with, 40 million or less people fit in? You have these huge markets of hundreds of millions of people, like even Mexico is over 100 million people, and we're moving away rather than towards freer trade. Why would anybody build a new factory here, especially as an exporter? Because you have good but not guaranteed access to these big markets, and that access could get reduced. Why not just go into the big market itself, where in most cases are much more cost-effective than Canada? So I think Canada is going to be a real laggard for quite a number of years to come, based on the innovation side of things, based on this slow move, it seems, away from freer trade, and the fact that we have a household debt problem that at some point in time is going to go into reverse and be a real drag.
It's interesting I don't want to get into this subject today because we've got other things to talk about, but is there a subject, or at least it's right up there with all the other economic subjects that are the public discussion is so off base? Well, I just love how you've put that. Canada is a small country. It needs other markets if we were going to continue to raise our standard of living. That's why we need free trade agreements. There's a lot of other benefits to it, and not every industry benefits because they're not competitive, and only through protection do they remain in business. So that's for sure. It's not a one-size-fits-all kind of solution, but the fundamental is when you've got 35 million, 36 million people, and you can access much larger markets in terms of population, that's a good thing for Canada. And that's why what's going on in the States is so worrisome, both from Donald Trump and Hillary Clinton in their populist kind of push, being against free trade as if that's their problem, which it isn't down there.
No, it's not. The U.S. is hyper-competitive, and it can do quite well. They tend to emphasize trade by only talking about the deficit in goods trade, but when you look at services, the Americans have quite a large surplus. Same in the United Kingdom. So this is not unique to the U.S., but it certainly for us is front and center there, and the rhetoric is really scary. So I think the status quo in terms of the American approach to things is dead, even if Hillary wins, and it's not clear how governable the U.S. is going to be afterwards. And I think that there are tremendous risks to the global economy and particularly to Canada in the aftermath of this election. We have to see how it plays out, but I'm quite anxious about it.
And we should be. I got to take a break, but I got to make one quick comment because what you just said there, I think hits the nail on the head. I think the Canadian media has been so Trump-focused. Every little faux pas, every little miss, is getting reported on or tweeted on or Facebooked on, whatever it is. They're missing the big picture completely. And that is, we're talking about two disastrous candidates here with the lowest approval ratings in history now, officially in history. They're going to start their tenure with the lowest. There's going to be no honeymoon here. And your point about, is it going to be governable? That's the bigger story, is what comes next after either of these people. And again, we're so enamored with sort of petty politics. We are completely missing the big picture. And I wish the media would do a lot better job on that. But I don't think they get the big picture. They don't get what you just alluded to earlier. We're in a process where we're leaving the public sector in favor of the private sector, and that's got a lot of implications. But speaking of that, John, we got to take a break. I'll come back. I got to ask you about the Federal Reserve. My goodness, this game of will they, won't they is getting a little extensive here. John Johnson's executive VP, but he's a chief strategist. I'll ask him what you should do with your money now. Davis Rea will be back with him across the Money Talks Network. John Johnson, my guest. He's the executive VP, chief strategist, Davis Rea. John, before the break, I just alluded to the Federal Reserve. I mean, isn't this getting a little ridiculous? Every week it seems like there's some other, are they going to raise rates? Are they not going to raise rates? Where do you stand on that now for the September meeting?
Well, we people are turning themselves into pretzels trying to make sense of all this stuff. I spent some time this last week reading some Fed speeches, and in particular Janet Yellen's speech from Jackson Hole, Wyoming, and also Stan Fisher's speech on productivity. And the two of them had very clear statements in their speeches about that the need to raise rates was the argument about raising rates was getting better. And if Alan Greenspan or Ben Bernanke had used those phrases, the market would have immediately priced in a 25 basis point rate hike at the next meeting. And with the new Fed, the market went from about a 33% chance of a rate hike in September up to about 42, 43%. So the market doesn't pay a huge, despite all the anguish over it, the market, in terms of putting their money to work, aren't really listening to the Fed that closely. They skew the odds a little bit in the direction because the Fed talks a lot and doesn't do much. And they seem to find the Fed seems to want to raise rates, and I think that over time they'll raise rates, a couple times to get away from zero. But they seem to find every excuse not to do it, and I think that I was thinking that they were laying their groundwork for a September rate hike, but in light of the two economic releases this week that I thought were quite important, the job numbers on Friday morning, which disappointed. But for me, more importantly, the big drop in the Institute of Supply Management Manufacturing Index on Thursday, I think they've got the excuse to not do anything. It seems that no matter, even if there's a windstorm, they'll back away from it. But they seem to be, their words are having less and less impact on the market. Mm-hmm. And I think that over time they're going to lose credibility. They are losing credibility slowly but steadily. But certainly I think what's very clear here is that the Fed's own forecasts, which show a sustained increase in the Fed funds rate over the next several years, nobody believes it. And I think that, maybe the Fed funds rate goes up to 1%. I think that would be appropriate. But I think I don't believe that there's much cause here to think that that short rates in the U.S. are going to move sustainably above 1% in the foreseeable future.
We've only got about a minute left, but bottom line, you're going forward into the fall. What are the one or two points you want to make for individual investors?
I think I would think that we've had the bear market. That was last year. It turned out not to be nearly as severe as I thought. I thought there'd be another down leg. So I think that we're probably in a cyclical bull market still. We're due for an intermediate correction. I think riding out the fall with a bit of extra cash, and I think the equity markets will end the year on a better note. I think the economies will end 2016 on a much better note than they started at the global U.S. and Canadian level. I think rates are going to stay low. And in many ways, I'm looking back at the period after 1986 when commodity prices crashed. The Canadian dollar hit 70 cents for the first time. And then we had a move upwards for a couple of years where commodities, the resource sectors, the TSX outperformed the U.S., the Canadian dollar went up, and I think we're in that kind of environment. I'm still a long-term bear on the Canadian dollar, but there's a cyclical bull market in the Canadian dollar out there through the end of the year and into 2017.
Great stuff as always, John. I appreciate it so much that you found time for us on this long weekend. All my best. Look forward to chatting with you again soon.
And you too, Michael. Thanks very much.